purpose of these talking shop videos is to give clients a glimpse into how we think about the market and investing. Some clients think as professionals, we know what's going to happen in the market's future. Unfortunately, we don't. But we do have both knowledge and experience of what works in different market environments. The analogy that Chris has shared with me, and that I think works well, is that good investment managers are like whitewater rafting leaders about to take their clients down an unexplored river. We have no better insight as to what's around the next bend than our passengers do. But the difference, and it's an important difference, is that we have navigated lots of different rivers, we don't panic, and we should be able to use our experience to everyone's advantage. Today we're going to talk about what may lie ahead based on what's happened so far, and how you might want to position your portfolio and navigate this rather unusual time. We're going to spend the bulk of this episode on the United States equity market, where Chris's research has produced some really interesting insights into what's going on. We'll also weave into information about other parts of the portfolio and other classes like alternative investments. So Chris, what has your research uncovered?
Thanks, Kurt. It's nice to be here. I think the most important thing that clients need to know about what's going on in the market now, and they may understand this intuitively or they may not, is that the returns are terrific, but they're coming from fewer and fewer stocks, and these stocks are getting bigger and bigger, and that's going to have some consequences that we're going to talk about. Okay, the first thing I'd like to do is show this chart, which graphically shows in detailed form what I'm talking about. Our viewers are probably aware that the S&P 500 is a market cap weighted index. The bigger the stock, the more effect it has on the index. That means a stock like Microsoft, for example, with a market cap of almost $4 trillion, has almost 100 times more effect on the index than, for example, General Motors, which has a market cap of, quote unquote, only $50 billion. As you can see by this chart, the largest 10 stocks by market cap now account for almost 40% of the index. And that's the highest number in more than 35 years. That means that the other 490 stocks in the S&P 500 make up only about 60% of the index. To put it another way, 2% of the stocks make up 40% of the returns right now. And it's moving ever more towards a top-heavy outcome. And of course, when you talk about the highly publicized Mag 7, that's NVIDIA, Microsoft, Apple, Amazon, Google, Tesla, and Meta, they've been driving market returns for more than 2.5 years. Again, I think people realize this conceptually, but I don't think they understand it in the actual numbers and the extremes to which this has gotten. So this chart shows the S&P 500's return, the top line, since the beginning of 2023. It's up about 75% in those 2.5 years, and that's pretty astounding. That's almost triple the average market return for the last 100 years. But the middle line shows the same 500 stocks unweighted, same stocks, but in other words, General Motors counts just as much as Microsoft in the middle line. The average return, therefore, of those 500 stocks was only 37%. Still great, but only half of the S&P's high-profile return. And I've also put in the healthcare sector of the S&P, which is that bottom line, and it's up only 1% for 2.5 years. We're going to come back to that. But if you focus in on the Mag 7 now, the numbers become incredibly extreme. Now let's look at the next chart. The Mag 7 stocks during the same time period are up almost 300%. That means they've almost quadrupled in 2.5 years. And these are gigantic stocks like Microsoft and NVIDIA. So they are pulling the market cap weighted index up with them in a big way. Okay, so that's the situation. Why should we care? To understand why this is worth focusing on, first you have to understand how aberrant these returns are. So since 1960, the annualized return on stocks has been between 10 and 11% with dividends reinvested. But since the beginning of 2023, the S&P has returned 24% per annum. And get this, the Mag 7 has returned a whopping 67% per year. These are unsustainable returns. Intuitively, we all understand that, but the math is important. Very roughly, earnings need to eventually keep up with stock prices. And earnings simply can't grow that fast year after year after year. And so something is going to happen, not rocket science.
Chris, so that's a super interesting point that you made about the large divergences that you're seeing in the U.S. equity market, especially when you looked at market cap weighted, where the larger companies have a bigger vote versus the equal weighted, where GM has the same vote as something like Microsoft. So going back to that whitewater rafting analogy, what are we going to see as we round the bend?
So we don't know exactly what's behind the next curve, Kurt, but what we do know is things can't keep on going the way they're going. Now, they could keep on going for much longer. They could stop next week. We just don't know that. But for a preview of what might happen eventually, I actually think that the market in the first quarter of this year was a good proxy for what happens when things change. And let's take a look at this chart. In this case, and I'm talking about the period from January to March of 25, fear of tariffs, economic slowing, caught up with the market. And during that short period, the Mag 7 declined 16%. And the S&P also fell over 4%. But here's where I want to bring up and bring back to the fore the S&P healthcare sector. During that same period, it was up 7%. Investors, when they are scared and they think things have gone on for too long, they go towards two things: safety and cheapness. And it's great to find a sector that combines both of those things. Right now, I really think that sector is healthcare. It's been shunned, ignored, and valuations have fallen to 30-year lows. Let me take you to this chart. This chart shows the percentage of healthcare in the S&P 500. And as you can see, it's at its lowest level since the early 1990s. So it's a generational low. We think that really represents a long-term opportunity. Now, let's take a deep breath, because in the short term, that doesn't really matter. In the moment, the market remains in a strongly positive upcycle. And it's worth pausing to consider why we're still in an upcycle, even though things have gotten expensive. The market is top-heavy, and we're aware of that. But what trends are making it bullish? Well, there's several things right now. But one of the ones I'd like to focus on, which I don't think people do spend enough time on, is the enormous amounts of capital expenditures that companies are pouring into all parts of the economy, but specifically artificial intelligence, AI. Take the four biggest companies in AI: Microsoft, Amazon, Google, and Meta. They alone have plans to spend almost $400 billion building data centers and other AI infrastructure just in the next year. Now, if you remember pre-COVID, if the economy would go into recession, Congress would pass a stimulus bill to try to get money spending again. And those stimulus bills were around $400 billion, more or less. So we have just four companies spending what is the equivalent now of what used to be a congressional spending bill.
So you highlighted healthcare as an attractive area of the market. Can you just give us some context on what are the valuations you're seeing in healthcare stocks relative to some of the more in favor areas like technology?
Sure. Well, Kurt, I've been doing this long enough to remember when, for example, the pharmaceutical companies were darlings in the 1990s, for example, and they were selling at 20 or 30 times earnings. Well, now those same companies have investment-grade balance sheets, really good dividends, which are safe, and they're selling at single-digit PE multiples in a market that's selling at 21 times earnings.
And since we're going into more detail on this, are they cheap for a reason? Are they
Sure.
fundamentally broken companies? Are they value traps? Or are they just unloved right now?
Those are a lot of different questions, I think, but let me answer them one at a time. One, I absolutely think they're cheap for a reason. It's drug pricing is in the crosshairs. Tariffs are being applied to pharmaceutical companies. But I would postulate that much of that is in a stock that's a terrific cash flow machine, but selling at single-digit PE ratios. The biggest problem with, I think, the healthcare sector as a whole is that the money has really moved like a tidal movement towards technology and communication, towards AI, and has left high and dry these pharmaceutical companies and other parts of the healthcare sector.
Chris, you mentioned these companies, these four companies spending nearly $400 billion to power AI for them and their AI solutions that can hopefully drive a lot of productivity and a lot of profits for them. Can you just give us some more insight into kind of the bull case? Why are investors so excited?
Sure. Well, this reminds me a lot of the late 90s where the internet was going to change the world. And indeed, it did change the world, as we all know it. So what I would say is AI will almost certainly change the world at least as much as the internet. The problem for investors is, will their particular investment have a good enough return on capital to justify the high prices we're seeing now? And that's far less certain than whether AI will change the world. For example, again, back in the late 90s, there were plenty of internet investments that if you bought them near the top would have been terrible investments, at least for the next succeeding decade. So you've got to be careful and weigh your options. Again, very positive on AI, very discriminating on which AI investments will work.
Do you think our next Talking Shop podcast will be done through AI and we'll be talking to virtual Chris and virtual Kurt?
Right, and then we'll both be out of jobs, which again is another problem the economy will have to cope with in the coming years.
So I think this is an area worth digging into. We talked about touching on other asset classes, although our focus has been on U.S. equities. When we think about the impact of AI, we're certainly seeing it in private markets. And we're seeing opportunities to participate in things like data centers, where part of the thesis is trying to provide the picks and the shovels to the AI industry and do so in a way we're able to take advantage of this mega trend, but in a way that provides some amount of downside protection. And so that transfers the risk from who's going to be the AI winner, which I think at this point is a little bit uncertain. I don't know if you agree.
I agree with you, absolutely.
To trying to play the credit of some of these mega cap tech companies, which their stocks have performed very well. But from a balance sheet perspective, I think we'd probably both agree that they have strong balance sheets. They do have real substantial amounts of cash flow. I think the bigger question is, will they earn a satisfactory return on that capex?
Yeah, and I think you're asking exactly the right questions, Kurt, because there's different ways to invest. So as an equity guy, I want to see what's the return on this stock going to be. But as you correctly point out, there's terrific ways, even if the stock doesn't do well from its current high levels, to make a strong return on some of these AI-centric companies by investing on their balance sheet, whether directly through their bonds or through leveraged or alternatives.
So Chris, we could probably spend all day talking about the potential impacts for AI on different asset classes. But to bring this back to U.S. equities, where does this leave us, in your opinion?
Well, I think an investor has to hold two things in their minds at one time. The first is that stocks are historically quite expensive right now. And so that embeds an element of risk within them. But at the same time, we're at a particularly beneficial point in the U.S. economy. Companies are spending a tremendous amount on capex. Earnings are coming in quite strong, and tariffs appear to be not upsetting the apple cart, at least at the moment. So the market, understandably then, has a lot of momentum behind it. You can't just take your money and go to cash because you're scared. But what you can do, and I would urge folks to talk to their advisors about this, is look for those places in the market which have high quality companies but have been left behind in this kind of, I think it's fair to call a craze about artificial intelligence. And those are the stocks that have the potential to keep performing well, even when, it's not an if, it's a when, the artificial intelligence craze calms down to a more commonsensical long-term approach.
And I think that dovetails so nicely. One of the key tenets of our investment philosophy is diversification. And so we've spent a lot of time talking about diversification within U.S. equities, areas that might be attractive. But in those conversations with your advisor, you can also touch on diversification across asset classes. So including things like fixed income, including some of the opportunities that we are seeing on the alternative investment side.
I think that's absolutely right. And I'm, again, the guy that focuses on equities, but that's just one piece of the puzzle, and it is not the whole picture. So I would urge people, especially when the equity markets look relatively expensive, to look at all their options and talk to their advisor.
So it sounds like there may be some potential class 4 or 5 rapids ahead. But Chris, I do want to thank you for your insights. I think your research has uncovered some really interesting information about the U.S. equity market that will be beneficial to our clients.
Well, thank you, Kurt. It's always a pleasure to be with you, and it's a real interesting time in the markets, and there's strong momentum, yet risks that are embedded in the current high valuations. So as always, it's a challenge, and we look forward to facing those challenges together.
Thank you again, Chris, and thank you everyone for listening.